It's damn near impossible to keep up with the DeFi space right now. Projects that you never knew of 2 weeks ago dominate the crypto news. Protocols that were worth nothing last week suddenly have more dollars locked in them than your entire college endowment fund. It truly is the Wild West in these frontier markets. A digital 21st century gold rush. But sometimes, when sifting through dirt in search of gold, you come across diamonds. One such diamond is a project called Universal Market Access, UMA, or UMA for short. And for those of you who follow my Telegram channel, you'll have seen me talking about it a few weeks ago. Well, today I'll give you everything that you need to know about UMA. This includes the following: what it is, the tech, use cases, token economics, and price potential. Finally, if you watch till the very end, I'll let you know my personal view on UMA and whether I will be adding it to my portfolio. Before we embark on this DeFi adventure, I have to make sure we're all strapped in. First order of business, not a financial advisor. Sorry folks, I didn't take that test. This all means that everything I say is purely for educational purposes. Secondly, if this is the first time that I'm gracing your screen, then welcome to the Bureau. Over here, I cover everything crypto. News, reviews, overviews, the whole caboodle. So if you value that, then I highly suggest you hit up that subscribe button and turn on those notifications. Get these videos straight from me to you. Finally, I've provided you folks with these handy timestamps right here. So feel free to jump around to different sections. Okay, enough beating around the blockchain. Let's crack on. So, what the hell is UMA anyway? Well, it's short for Universal Market Access, and it's a decentralized protocol for creating financial markets that are globally accessible. It provides a framework for users to create synthetic derivatives on the Ethereum protocol. Okay, so that's a bit of a mouthful, but essentially it allows any two users to enter a financial contract, one that does not rely on some centralized entity to enforce. One that's secure with economic incentives alone and is therefore self-enforcing and universally accessible. So then, why is this even needed? Well, because currently, financial markets are not very inclusive or universally accessible. Think about the process that you'll need to go through in order to enter a swap position currently. You have to get a brokerage account, complete KYC, AML, and investor suitability questions. You then have to post considerable margin on your account in order to open any positions. You have to also trust that your broker is able to manage the risk in your account with the margin you put up. If there's a situation where markets were to move considerably against you, then you could get negative equity, which could mean legal recourse. This can be daunting for those of you who are only just entering the world of financial contracts and derivatives. Moreover, the range of derivative contracts that you can trade on the open market is somewhat limited. Most of the time, you'll be entering a position in a standardized contract that is traded on the open market. If you wanted to structure a more bespoke financial contract that's not traded on the open market, you're going to have a tough time. Yes, while Wall Street boffins do structure unique and exotic derivatives in the OTC market, they're usually restricted to institutional and regulated entities. There's also considerable paperwork and legal rigmarole that's required to structure these types of deals. So wouldn't it be cool if I could just enter a simple agreement with you, person to person, mano a mano? No need for a broker or clearinghouse. No need for lawyers or any laws for that matter. A contract purely governed by code. That's exactly what UMA is trying to achieve, and how it is trying to do that is really quite ingenious. UMA defines an open source protocol that allows any two counterparties to design and create their own financial contracts. This is all through the use of completely trustless and decentralized Ethereum Smart contracts. Each UMA contract comprises these 5 separate components. Public addresses of all the counterparties. Margin accounts for each of these counterparties. Economic terms to calculate the value. smart contract functions to maintain the margin balances, and an oracle that will provide secure and verified off-chain data. These components help to ensure that the contract is able to enforce the rules agreed in a trustless and secure manner. In order to understand exactly how this works, let's take a look at a pretty simplified example. So, you have two counterparties, let's call them Chad and Karen. Yes, I know we usually use Alice and Bob, but this is DeFi and we have Chad, so yes, I'm retiring Alice and Bob. So, Chad and Karen are betting on what the price of Chainlink's Link will be at the end of the month. Being a member of the Link Marines, Chad thinks it will rally in the month and end up higher than where we are now. Karen is a bit of a Link bear and thinks that the price will fall. Both sides will then agree to formalize their trade and enter into a self-enforcing UMA contract. They agree to a margin of 10% that will be deposited into the smart contract. This also functions as a bond to keep them both honest. If they misbehave, they lose their margin. Also, they will agree to a default penalty. This is the amount that will be lost if either party fails to top up their margin should it fall below a minimum level. Let us assume for this example that they have agreed to a 3% default penalty. It's also important to note that margin and prices are denoted in USD, whereas it's paid and stored in ETH. Okay, so back to the trade. Over the month, the price of Link increases, which means that Karen will automatically contribute more ETH in order to meet her margin. The more it increases, the more she will have to contribute, and vice versa for Chad on a Link decrease. Then, at the end of the 1-month contract, if Link has ended up, Karen would have been contributing margin automatically, and the contract is just settled with Chad being paid his earnings. No intermediary needed. Oh yes, and on that default penalty. That is in the contract in order to penalize any party should their margin fall below the minimum account required. It's used as a disincentive mechanism to default on margin requirements. Okay, so this is a basic overview of how UMA works. However, the underlying mechanics of it can be quite involved. So, I want to try and explain this tech stack as best I can. The first thing that you need to understand about UMA is that it relies on this concept of priceless financial contracts. Okay, so what do I mean by that? Well, basically it means that these contracts do not require an on-chain price feed to function. They also try to minimize the use of any on-chain oracles, as these can be open to oracle manipulation. This is something that has happened in the past on other protocols such as BZX. I covered it in more detail in my Chainlink video if you want more info. Now, these priceless financial contracts are designed with mechanisms in order to ensure that the counterparties will always collateralize their positions without relying on any of these price feeds, hence the term priceless. As mentioned above, you have that liquidation process that punishes those counterparties that don't collateralize their positions. You also have incentive mechanisms that enable others to get rewarded to identify said under-collateralized positions. The real genius point here is that oracles are not needed unless there is ever a dispute about a liquidation. However, the economic incentives built into the protocol are designed in order to make the need for this dispute process infrequent. Still with me so far? Okay, so let's assume that there is a dispute about a potential liquidation. Then you're going to need input from that decentralized oracle network. The UMA team have called this their DVM, or Dispute Verification Mechanism. It is designed to respond to price requests made by financial contracts that are registered with it. These price requests then ask UMA token holders to vote on the value of a price identifier at some historic timestamp. This decentralized dispute mechanism takes about 2 to 4 days to settle. Once votes are collated, the mode of these price commits is calculated and used to settle the contract. The financial contract then distributes collateral to its counterparties based on the value returned by the DVM. Now, the real genius of this DVM oracle design is that they've developed a game-theoretic equilibrium where the cost of manipulating the oracle is always greater than the profit that could be earned by corrupting the oracle. So, in other words, the cost of corrupting the DVM, as measured by the cost of 51% of the UMA voting tokens, should be greater than the profit from corrupting the DVM, as measured by the collateral stored in the financial contracts that are registered with it. Here's something interesting though. In order to make sure that the inequality holds, the DVM will have to make sure that the UMA token is above a certain price. They'll do this by charging fees and burning some of the outstanding supply. This has important implications for the tokenomics of UMA, something that I'll get onto in a bit. Okay, so I know that was a lot to take in, but it's only just scratching the surface. I've linked to the docs and white paper below should you want a more in-depth read. The main thing to take away here is that the UMA protocol has taken the approach that any on-chain oracle can be manipulated. As such, they've structured an incentive mechanism that reduces the need for them, and in the event a price dispute arises, they use a decentralized voting mechanism to verify said price. This makes them quite different from most other DeFi smart contracts that will mostly just integrate with an off-chain oracle service like Chainlink or the Band protocol. Now, I know what you're thinking. Why can't they just integrate with said service? Why do they have to use this pretty involved incentive mechanism? Well, that just comes down to the customization options available. While Chainlink does have a pretty extensive range of price feeds these contracts can reference, it's by no means exhaustive. There are numerous price feeds that people may want to use in a smart contract that are just not available. What about exotic currencies, commodities, stocks, altcoins? They can't support everything. They tend to only support those that are in demand. That's just logical. However, given the nature of UMA's DVM, anything that has a price can have a contract structured around it. Heck, it doesn't even have to be a price. It can be any market metric. Here are a few examples. Tokenized yield curves, total value locked in DeFi contracts, bespoke futures, total return swaps, insurance plans, retirement plans, etc., etc. These types of financial instruments cannot be structured using traditional smart contracts and oracle designs. It's a major unique selling point for the UMA protocol. Okay, so you understand the value of the project, but that's only one component of it. We also have to consider that UMA token. So let's jump into that, shall we? The UMA token, ticker UMA, is an ERC20 token on the protocol, and its main purpose is as a utility token. There was an initial supply of 100 million UMA, and the distribution has been broken down according to this schedule right here. As you can see there, it had an initial Uniswap listing back in April where they sold off 2 million tokens for a price of 26 cents per token. You'll also see that there's over 48% that's reserved for private backers and investors, an important point that I'll touch on later. When it comes to the use cases for UMA, there are three main functions. They are governance, where users can earn inflationary rewards for participation. Disputes, where tokens are used to incentivize price requests during these disputes. Fees. I mentioned this before, but these are fees that are burned to increase the price. Let's take a look at each of these. When it comes to governance, holders are expected to participate in votes around UMA improvement proposals. Those that do are rewarded 0.05% of the total network supply that's distributed pro rata according to the amount staked. This has the effect of increasing the total supply every year, albeit at a really low rate. Looking at these disputes, the token serves an important purpose when it comes to the safety of potential oracle attacks. UMA tokens are used for voting on disputes, and as such, they have to be expensive to obtain. More so than any potential attacker could earn for manipulating the oracle. This cost of corruption is the amount required to control the process, 51%. And then finally you have that fees component. That actually ties in with the dispute mechanism. Fees are charged in order to burn supply and increase the price of UMA. This is done in order to make sure that the cost of corrupting the oracle is more than the potential profit that can be made from corrupting said oracle. Okay, so those are the tokenomics of UMA, but how does this impact on the price? Well, let's take a look at the supply side. Firstly, you have the protocol inflation, which is currently 0.05%. This is actually really mild when compared to most other tokens and is even less than inflation on the likes of Bitcoin. So I don't expect this inflation to be that consequential. However, you also have those burns that are taking place in order to decrease the outstanding supply and hence increase the price. The exact amount that's charged in fees will increase in proportion to how much is being locked up in the contracts. This just makes sense, as they have to make the cost of corruption at least more than the cost of corrupting. In other words, as more and more contracts and more funds are locked in them, the higher the price of UMA will have to be in order to secure the DVM. This will all be done with increasing fee burns that will decrease the supply. So you have strong upward price pressure coming from those burns, which is highly outstripping the inflation that is built in. But we still need to look at that demand side. Firstly, as more people are entering these contracts, they will need to buy UMA in order to pay the fees for potential disputes. You then also have governance demand. This one is a little harder to measure, as it just comes down to the demand users have to be able to vote. But we only need to take a look at some of the insane moves in governance tokens like Comp and Waifu to get a sense of it. These guys have no other use cases apart from governance and have rallied to all-time highs. So, if we combine these increases in the demand with the reduction in supply that I mentioned earlier, then, holding all other factors equal, we are likely to have an increase in that price. Of course, the price movements over the past month have been less fundamental and more speculative in nature. Allow me to explain. As mentioned, UMA went through an initial DEX offering on Uniswap earlier this year where they sold their tokens for 26 cents. For those who bought in, the ROI has been pretty insane. Heck, even when I mentioned UMA in my Telegram channel last week, it was only trading at $6. So it's quite clear that it's being picked up in the DeFi craze. The same has happened to other projects such as Waifu and Waifu 2. However, there could be a good reason for this monumental price rise. As speculated in my channel last week, UMA was a prime candidate for a Coinbase Pro listing based on a number of factors. Well, just yesterday, Coinbase Pro announced that they would be listing UMA and transfers would begin tomorrow, with trading not much longer after that. As we all know from recent history, Coinbase Pro listings can have a monumental impact on the price of a token. You have recent examples such as Compound, Cello, and OMG, to name just a few. So, it appears as if some in the market were speculating just as much. So the increased liquidity provided by the Coinbase Pro listing could have a positive impact on the price. Now, that's it for most of my overview, people. To be honest though, that's only just scratching the surface. We haven't even got on to other topics like UMA liquidity mining, etc. But I think this should have given you a basic overview of what the project is about. So it's time for a few of my own concluding thoughts on it. I have to say I'm really impressed with this project. They've tried to use a novel approach to attack the relatively complex problem of a secure and comprehensive Oracle system. Through the use of economic incentives alone, they're providing a framework for users to enter decentralized financial contracts on any underlying asset. Financial contracts that need nothing more than those two counterparties to enter. What I found particularly interesting about UMA is the immense range of customization options. No longer do you have to rely on the currently supported decentralized derivatives. If there's something that has a price and you would like to structure a deal around it, UMA provides the tools to do it. And this is not all a theoretical construct. They have already launched a number of synthetic derivative contracts. These include more mainstream variants like the ETH-USD or exotic DeFi flavors like a Comp synthetic derivative. They've also put that DVM dispute process into action with a recent dispute on an ETH-USD contract. Settled in a completely decentralized manner, all thanks to those UMA holders submitting their votes. Now, something that I did not get time to go over in the review is the team behind this project. It's stacked with some pretty smart and accomplished individuals that studied at the likes of MIT and have worked at companies like Goldman Sachs. It also has some pretty impressive backers, including the likes of Bain Capital, Placeholder, 2 Sigma, and Coinbase, among others. And speaking of Coinbase, it will be interesting to see what impact this has on price. If the past is anything to go by, it will have a big effect on it. Is this adoption likely? Well, I'll leave you with this fact. The global derivatives market is estimated to be worth over $1 quadrillion. Yep, you heard that right. If UMA even captures the smallest sliver of that, it's massive potential. Now, when it comes to my own personal portfolio, I will be looking to pick up some UMA in the coming days. I'm looking for a good entry point as it has had a strong rally in the past 2 weeks. It's especially volatile now in the wake of that Coinbase announcement. I'll keep you folks updated on this in both my Telegram channel and in my weekly newsletter. And speaking of which, if you've not signed up to my newsletter, then you can do so right now with a link that I've put in the description. It's a weekly email that summarizes and crystallizes my views on the market. I also have coin tips as well as share the breakdown on my personal portfolio. So yeah, in the description. That was a long one, team, so top marks if you made it this far. There is one thing left to do, and that is to collate your all-important feedback. So, what are your views on UMA? And what other DeFi projects do you have on your radar? Feel free to fire me your comments below. Also, while you're down there, you may want to check out my deals page. I've collated some of the best promos and giveaways in crypto, including the trading competition I'm currently running. Finally, if you enjoyed this content, then please let YouTube know how you feel and smash that like button. Of course, you'll also want to subscribe to make sure that you don't miss all the videos that are headed your way.